The most united Federal Reserve since 2011 decided to take a further $10 billion from their bond buying programme, yet still the US is expanding. Joining me down the line to discuss is Edgar Walk. Edgar, GDP came in at 3.2%. That's right on target, really. Now, that is well below quarter three's 4.1% advance, yet analysts still seem encouraged. Why so, do you think?
I think we had a very negative effect from government spending. So a decline in government spending took around 1 percentage point off GDP growth. And this has to do with the government shutdown in October last year. So if the government shutdown wouldn't have happened, I think we would have had a growth around 4 or even more than 4% in the US in the fourth quarter, which is a very strong number, given also that consumption spending was very strong and contributed around 2.3 percentage points to GDP growth. And I think that's why markets react very positively to this number.
Also out today was the jobs numbers. At the moment, the numbers look a bit tired on this front, although claims have come down recently from the surge in December. Do you think the sluggish retreat in new filings for unemployment benefits this month is a sign of a cyclical rough patch or a temporary winter freeze that will thaw with the warmer weather?
I think it's extremely difficult to say currently what are the main effects driving the weak numbers. My feeling is that a lot of the weak numbers is driven by the extreme cold weather in the United States. So we should see maybe in February or March a recovery or some improvement in the jobs data. And I think this is also the opinion of the Fed. When we look at the statement yesterday from the FOMC, we see that they remain very optimistic about the economic outlook for the United States. So it seems that they also think it's a temporary weakness we are seeing, not a new cyclical or structural weakness in the labor market.
Given this seasonal volatility, analysts said in advance a soft report for claims can be dismissed as noise. But could this also be a reminder that next week's payrolls news could be lackluster too? And can the markets cope with this?
I think we have already seen a weak number in December, and I think that was mainly driven by the weather. And I would also expect to see some weakness next week. And my feeling is that markets will not react very strongly to the number, except if we have a very strong deviation from expectations. So if we get an exceptionally weak number, we should see some market reaction, but not if non-farm payrolls disappoint by 50 or 70,000. I think this should be still in the margin of error. So overall, I also would expect some weakness in January, given the influence of the weather in the United States.
There are a few potential speed bumps ahead. The inventory totals and turmoil in emerging markets could affect trade. Do you think this will have a significant effect on quarter one data for the US?
It's difficult to say because we should see some payback. So maybe the effect will not be so strong. I think we will see another some GDP number between 3 and 4% growth in the first quarter in the US. So if we have some weakness now, we will see some payback later. So overall, it should be another very strong quarter in my view, the first quarter.
The strongest currency performances have come from the US dollar and the Japanese yen. But how do you see these two performing against each other? Continued tapering is expected to provide strength for the dollar, but do you think the Bank of Japan will be comfortable with the current levels? And how are you positioning yourself accordingly?
I think we have a very strong consensus opinion that the Japanese yen is on a weakening trend or a downward trend. And I fully agree with consensus. Yeah. It's always the aim of every analyst to find forecast which differs from the consensus. But I think in the case of Japan, we see very strong measures by the Bank of Japan, which have very strong effect on the foreign exchange market, which will, at the end of the day, lead to a weakening of the yen. what we have seen at the beginning of the year was that the market was very strong positioned for further yen weakness. So we had extreme yen short positions, and this, in my view, this extreme positioning caused some of the yen strengths we have seen in recent days, because short were covered. But I think overall the trend for the Japanese yen is downward, especially so that we are seeing now that the Fed is strongly determined to cut the asset purchasing program by around 10 billion every meeting, and also in the light of very strong economic data out of the US.
Edgar, great to have your perspectives on the show. Thank you so much for your time. Well, viewers, that's all from me for the moment, but for a reminder of what else has been moving and shaking the markets this week, make sure you click back tomorrow for the weekly wrap-up with Stuart McDermott. Goodbye for now.